Prepare yourself for more stock market volatility. Yes, a wild trading day in today's trading session. Looking at ES there, the moment we've all been waiting for, people. Jerome Powell is going to come out. It's a fact. 90% of all FinTwit participants have been diagnosed with irritable Powell syndrome. Now, if we take a look, what else is coming out on the macro calendar? We have JOLTS report, Fed chair, and then we have some big data even at the end of the week coming out. And remember, Thursday is a new month. So if you haven't done so already, make sure to subscribe to the channel. We are going to be doing updated monthly expected moves and going over those larger time frame charts when the month is over. So if we take a look at the Fed Watch tool, where is the market kind of, putting the probabilities of where the next rate hike will be? Well, there's a 66% probability that we're going to be seeing a 50 basis point hike. And this one's kind of creeping up here too to see a potential 75 basis point hike. And this is pre-Fed talk. So we will see what Jerome Powell has to say and if that shakes up the probabilities over here. And even if you look back into June, which is more into the middle of next year, go figure, we're looking at a pretty much locked in at around a 5%. So that means higher rates for longer. So where is this range going to break out? As you've all been probably watching, we've just been in a monster chop suey type of range here, the chop box, where we've just been pinging back and forth, and we are now coming up into an important week with, once again, a lot of data that can either break us or make us. Ooh, I did that on the fly. Now we do have a MACD that's curling over on the S&P 500. This does look like it's wedging up here, and we got some other indicators to talk about on today's show. Now this contractionary period, when I take a look at the zones, you can see here, more specifically in the ranges, which basically just tells us where price is, closing price, is between the low and the high of these ranges and of these assets. And as you can see, nothing's green, nothing's red. We have one little gray out here, which means it's coming close to either the lower or the upper channel of the zone. But you can see here, it is just in a period of consolidation. So we got to be patient. Consolidation also looks like just a bunch of chop. Now, if we take a look at some of the signal charts, what do we got going on? The summation index for the NYSE, the broader market. I'm still watching very closely this negative divergence playing out over here. We have lower highs, boom, 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 on the NYSE McClellan oscillator, and we have higher highs on the price action. Now, the summation index itself, as of right now, still it's above zero, and we don't have any click over yet. I want to watch that parabolic SAR uptick, and I want to see this start to curl over to feel a little bit more confident that we could be going down. If you look at the NASDAQ summation index, this one's getting pretty darn close, if I do say so myself. It's looking like it's in this early stages of rolling over. We had that negative divergence on the NASDAQ McClellan oscillator. You can see that with price here, and then the internals right here. And then this is just slowly starting to roll itself over. So is it going to start heading down faster and the parabolic SAR is going to uptick? We will see. That is just going to give us a potential shift, early, heads up notice that we could see a change in the overall trend. And that gave us a really great heads up right here. And it gave us a great heads up here and multiple other times. When you look at growth versus value and we measure a rate of change on that, it did click down through a negative rate of change. And I just highlighted on the screen various times. Now I'm measuring growth to value, but what's on the screen right here is actually the Qs. Okay, so in order to look at growth to value, that's a relative strength line, right? I'm looking at these two tickers up here, but I made them invisible. And then I'm measuring the rate of change of that. Okay, so it's a little confusing, but basically stick with me here. We have red lines going through the screen. Those red lines are identifying when we have a rate of change cross from positive to negative territory. And when we've seen that, we've seen the market sell off on the Qs. And you could see that multiple times, right? Bam to the downside, bam to the downside, bam to the down, bam, 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 bam. And then this was a big one right over here. This one triggered, and that marked the top of that last bear market rally from the June over there. And then this one just recently triggered, and we've already seen some sell side activity. So we'll see here, it doesn't tell us how far it can go down, but it does give us that little bit of a heads up. And we saw that crossover just the other day, and now we're seeing a little bit more sell side. But overall, like I said, we're just kind of in this contractionary chop box, okay? Now, a couple other things to pay attention to, especially when it comes to tech stocks, is the 10-year yield. When we see the 10-year yield rise at a rapid rate, it puts pressure on growth stocks, okay? We've seen that countless times, and we're starting to see this little uptick or breakout potentially of this wedge pattern as it stands right now. Now, if this does want to shoot off, I think we're going to get more action on the jobs report, but we'll see what Powell has to say. And if that is the case and it wants to press higher, that could put continued pressure on growth stocks. Now, if it starts to come off, hey, maybe the opposite happens, right? But you got to understand the overall trend still with tech is in bearish conditions. On the flip side of that, if you look at bonds, the TLT had a downside day. We talked about it coming into this higher area and how you don't really want to go long into that area because the risk to reward, it looks like the rewards to the downside because that's the overall trend versus the risk to the upside. So you want to wait to see if you can get some consolidation or if it pulls back to the lower range, to give it more time in order to feel a little bit more confident going long versus just having a big massive move, right? You always want to ask yourself, okay, well, where did price come from? Well, it came from down here and it basically went straight up, and that would be your long entry. It doesn't make much sense. You can get lucky, but understand that markets move between expansion and contraction, and right here, this was an expansionary move, boom, to the downside, and then now it's expanding, but now contracting, and contraction leads to expansion. And as it stands right now, that could very well be a potential bear flag. So we'll continue to watch that. Another asset to watch is obviously the dollar. The dollar has been finding itself some little bit of support at around 105. Now, if we take this and we go out a little bit further, this is one of the areas that we talked about where we had previous resistance, and then support, and now we're acting as support again. So if this floor is taken out, that could really send the dollar or send the S&P 500 up and various other assets, because we've seen countless times the correlation that the dollar has with the S&P 500. Okay, it's typically is a very strong negative correlation, and you can see that multiple times. Like if we have a move down, we saw the move up in the S&P 500. So as it stands right now, if the dollar starts moving back up and potentially trying to come for this trend line, we'll watch for that area that could potentially break this out. Okay, now if the dollar comes back down, boom, that could just be, somewhat of a bear trap. So we'll see. There's going to be a bunch of different possibilities. We just need a lot of data, and the market's been incredibly dependent on all these macro drops. It's been very, very difficult environment to trade, both intraday and swing trade, right? It's just been this whole week has been a little crazy, as you can see, just looking here, the price action's all over the place. Now, if we take a look at the SPY right now, we'll zoom in momentarily, but it does look like it's potentially flagging. But if we zoom in, you can see that it's been just doodling around. It's what? It's lower weekly expected move. We talked about a possible scenario of it coming outside of its weekly expected move and hitting the daily expected move, and it basically missed it by a few cents, not too much. The expected move for the day came down into that area, and then, well, it came straight back up into it. So if you're prepared for that type of a trade, cool, but it was a very difficult trade to just kind of hop into if you were looking for it, given the severity of some of the moves to the downside. Now, going into tomorrow, one of the things we wanted to touch on that we discussed yesterday was the expected move going into Jerome Powell's talk. Now, yesterday, the expected move was around $3.50 or right around there, and now we're looking at about a $4.50 move. So this move today was very volatile. Expect more volatility. And why do we say expect more volatility? Well, because the options market is pricing it in. They're pricing an expected plus or minus $4.50 move. Okay, so if we're looking at a $4.50 move, that can take us potentially down to this range up in here. This is rough math, to around right here. Okay, so that's a pretty large range that we can potentially go to, and that could come on the back of Jerome Powell talking. It could come on a potential jobs report. It can even come in the after-hour session. We don't know, but that is what the options market is pricing in, and they're correct. It's basically, if you look at it as a distribution curve, boom, boom, that's one standard deviation right in here, and that closes 68% of the time, right? So 68% of the time, the market's going to be right. Now, if it closes two standard deviations, that changes a little bit different, but you got to always consider that we can have, 2 sigma moves, which we've seen plenty of times throughout this year. A couple other indicators that I want to go over to. The value line geometric index. I like to look at this on occasion for divergences that form, and I'm highlighting a couple here that I shared on Twitter. You can see that the purple ones are the positive divergences where the XVG is putting in a higher low, and the S&P 500 is actually not confirming that and putting in a lower low. And then as you can see, when the XVG does that, you can see the S&P 500 goes for a rally, Now, I'm also highlighting in yellow the negative divergences, and that's where the XVG puts in a lower high versus the S&P 500 putting in a higher high, and that actually led to market sell-offs. And we have a subtle small divergence forming right here that I wanted to call out, right? It's already playing out a little bit to the downside, but who knows if this is going to have some more implications where it heads down and this drags it down further, and we actually have something like this, that bear flag play out, or it just breaks out of this tight consolidation and moves down like so. Okay, so that is one of the concerns that I have looking at That indicator, if you take a look at BPSPX, this is the bullish percent index. Also, remember, we have this negative divergence that's right here, and it hasn't really played out yet. As you can see, we said, it can stay overbought for a while, and it doesn't mean that it has to sell off dramatically. It could mean that we're just consolidating. And what do you know? We are consolidating right now in the S&P 500. So is a breakdown going to occur? Well, it's set up for a breakdown, but the consolidation also leads that, hey, there's also the possibility for it to break to the upside. Okay, and we'll talk about, levels to watch here momentarily. Another one to watch also is the industrials, the Dow Jones industrials, and then even transports, right? If you follow Dow theory, but you can follow these divergences as well. We talked about this, a couple episodes ago, how the transports were not matching up with the industrials. You can see the lower high right there in transports and the higher high in the industrials. And now we're starting to see a little bit of a consolidation or pullback there in the Dow Jones industrials. So is this a warning shot saying, hey, this is where we're going to consolidate or pull back in the industrials? It's something to consider. Also to consider is the negative divergence it's building in the BP chart itself in Dow Jones industrials. You can see the RSI is moving out of that overbought territory, but we have that lower high versus that higher high right there on that specific BP chart. So what do we got to wait for? What do we got to look at to feel a little bit more confident? It comes back to this chart. We are in a chop box. You can see the 200-day moving average is holding. You want to see price action get above this area, which is, just above that 400 range, or S&P 500, 4,000, 405, right there on the SPY, or you're going to wait for confirmation to see more of a breakdown from this range, 390 to 385. That should give us a little bit more insight to see if we start having trend days again, because as it's been recently, it's kind of just chopping us up. That's all I got for you on today's episode, everybody. Hope it helped out. See y'all later.